Ownership versus lending in investment. Stocks represent ownership in a company, giving investors a share of its profits and assets. Bonds, on the other hand, are loans made by investors to a company or government in exchange for periodic interest payments and the return of the principal amount upon maturity. This fundamental difference impacts risk and return. Potential returns. Dividends versus interest. Stocks may provide returns through dividends and capital appreciation, depending on the company's performance and market conditions. Bonds offer fixed interest payments, making them a more predictable source of income. While stocks can deliver higher returns, bonds provide greater financial stability. Risk levels in stocks and bonds. Stocks are generally riskier due to their volatility and dependence on market fluctuations. Bond investments carry lower risk as they provide a fixed income and are less affected by market swings. However, bonds may still carry default risks, especially with lower credit-rated issuers. Market performance and economic impact. Stock prices fluctuate based on a company's financial performance and market conditions. Bonds, however, are more stable, with their prices influenced by interest rates and credit ratings. In uncertain economic times, investors often favor bonds for their safety, while stocks thrive in periods of economic growth. Liquidity and accessibility. Stocks are highly liquid and can be bought or sold quickly on major stock exchanges. Bonds, although tradable, may not be as liquid, especially in secondary markets. Investors seeking immediate access to their funds may find stocks more suitable, while bonds are better for long-term stability. Time horizon for investment goals. Stocks are ideal for long-term investors seeking higher returns and willing to endure short-term volatility. Bonds suit conservative investors with short to medium-term financial goals, providing steady income and preserving capital. The choice depends on one's financial objectives and risk tolerance. Tax implications of stocks and bonds. Dividends from stocks and capital gains are often taxed differently than interest earned from bonds. In some cases, municipal bonds offer tax-free interest income, making them attractive for certain investors. Understanding the tax implications is essential for maximizing net returns. Inflation impact on returns. Stocks typically outpace inflation over the long term, preserving and growing wealth. Bonds, while stable, may offer lower returns that could be eroded by inflation. Investors should consider inflation-protected bonds, such as TIPS, if they prioritize maintaining purchasing power. Diversification benefits. Stocks and bonds complement each other in a balanced investment portfolio. Stocks provide growth potential, while bonds offer stability and income. Diversifying between the two helps reduce overall portfolio risk and ensures more consistent returns across market cycles. Choosing based on financial goals. The choice between stocks and bonds depends on individual financial goals, risk tolerance, and investment timeline. Stocks suit those seeking growth and higher returns, while bonds appeal to those prioritizing income and capital preservation. A mix of both often provides a well-rounded strategy.